Welcome. Thank you for joining me. Today I'm going to discuss key rules and strategies of Social Security so you can make a more informed decision about your retirement income. If you find this video helpful, please like it, subscribe to the channel, and make a comment if you have one. I'll be sure to respond. Social Security isn't one size fits all. Your choices have long-term effects. Stick around as I cover a wide range of claiming strategies. If you have some personal questions, be sure to set a time to meet. There's a link to my calendar down in the chat. First and most important thing to understand is that monthly benefits rise with your claiming age. In other words, the longer you wait to file Social Security, the higher your benefit will be. To illustrate this, we need a little background information. We'll start with some definitions. Primary insurance amount is your base monthly benefit, calculated at 62 and based on your highest 35 years of earnings. This is the amount you'll receive if you file for Social Security at your full retirement age. During this presentation, I'm not going to discuss how PIA is calculated, but it's essential to know that it's based upon your earnings history. If you earn your maximum Social Security benefit every year for 35 years, you would qualify for a maximum PIA, which in 2025 is $4,020.90 per month for those who are turning 62. If you have worked less than 35 years or have had several low earning years, you may still be able to increase your Social Security benefits by working longer and earning a little bit more. Our focus here is on claiming age, so let's keep going. Another term you need to understand is full retirement age. This is the age at which you can claim full, unreduced Social Security benefits. This used to be 65 for everyone. However, during the 1983 Social Security amendments, a higher age has been phased in. The full retirement age is now 66 for everyone born between 1943 and 1954, 67 for everyone born in 1960 or later, and 66 plus a couple months for those born between 1955 and 1959. You might take a second here and make a note of your full retirement age. As I mentioned, full retirement age is when you may claim full unreduced Social Security benefits. We saw that the maximum earner who turned 62 in 2025 would have a PIA of $4,020.90. They will receive this amount if they file Social Security at their full retirement age. Claiming Social Security before the retirement age will reduce your benefits. Your benefits will be less than your PIA. This is called the actuarial reduction. Conversely, claiming Social Security after full retirement age will cause your benefit to be higher than your PIA because the critical thing to understand about reductions and credits is that the Social Security actuaries have carefully calculated them to have the same effect on the system, whether you file at 62, 70, or any age in between. Social Security deals with the whole population, and they know that some will die early and some will live longer. On balance, it doesn't matter to them when people file or how much reduction or credit they will get. But it's essential to everyone because the age you file determines your permanent monthly benefit. If you live longer than average, or there's a chance you might live longer than average, you will be better off filing later and collecting a higher benefit, even if it means waiting a few more years for your checks to start. Now, remember that I said your primary insurance amount, or PIA, is the benefit that you'll receive at full retirement age. What happens if you apply for Social Security before your retirement? Your benefit is reduced. You'll receive a percentage of your PIA depending upon when you apply. If your full retirement age is 66 and you retire at 62, you'll receive 75% of your PIA. At 63, you'll earn 80%, and so on. If your full retirement age is 67 and you apply at 62, you'll receive about 70% of your PIA. These amounts are prorated monthly, so you can use them anytime after 62, and the appropriate amount will be reduced from your benefit. If you apply for Social Security after full retirement age, you will earn delayed credits of about 8% for each year you delay. So, if your full retirement age is 66 and you apply at 67, your benefit will be 108% of your PIA. At 68, about 116, and so on. After age 70, you can't earn any more delayed credits, so it really doesn't pay to wait until then to apply for Social Security. The age at which you claim Social Security determines your permanent monthly benefit. If inflation occurs in any year, your benefit will be adjusted to reflect the cost of living. In 2025, the cost of living adjustment was 2.5%. Historically, COLAs have varied widely, and the Social Security Administration projects COLAs over the next 75 years to be about 2.4%. The COLA is applied to your benefit amount. The higher the benefit, the higher the COLA will be, and it applies to benefits you haven't even earned yet. Once your PIA is calculated at age 62, it will rise yearly with the cost of living adjustments, even if you delay claiming until age 70. The upshot is that delayed claiming has a more significant advantage over delayed credits and cost of living adjustments. The when to apply question is complex and requires some customized analysis. But here are a few points to remember. If you apply early, your benefits will start at some fraction of your PIA, 75 or 80% or whatever, and remains at that percentage for the rest of your life. It will not exceed 100% when you reach full retirement age. Your COLAs magnify the impact of early delayed claiming because the annual cost of living adjustment is applied to either a lower or higher amount. This causes the disparity to increase with each passing year. When to apply also impacts survivor benefits. If the higher earning spouse maximizes their benefit by delaying to age 70, the higher the benefit transfer will be to the lower earning spouse at their death. We'll cover this in just a few minutes. Of course, you must consider your health status, life expectancy, income needs, and overall retirement plans when deciding when to claim Social Security benefits. Here are 3 ways you can estimate your Social Security benefit. First, you can refer to the annual Social Security statement. It's now available online. To set up an account, you must answer several security questions. You can use the retirement estimator, which is also available through your Social Security account. This calculator taps into your earnings history after entering your personal identifying information, which include dates of birth, Social Security number, and mother's maiden name. Don't worry, the site is secure. Please note that the annual statements on the retirement estimator do not factor in COLAs into your age 70 benefit. This means your actual benefit will be slightly higher than what they indicate. But my calculator adjusts for COLAs. So if you know your PIA, we can help you project your future benefits. You can try one of these 3 calculators on the Social Security website. Feel free to browse around the site and play around with the calculators. The essential rule number 2 is your spouse may be eligible for benefits based on your earning records. Before discussing the spousal rules, I'd like to clarify briefly that back in 1939, spousal benefits were created to give non-working spouses a small benefit based upon the other spouse's work records. But Social Security is a gender-neutral program. Husbands may be able to claim spousal benefits too. And now that same-sex marriage is legal in all states, either spouse, regardless of gender, may claim Social Security. In this age of 2-income families, spousal benefits may be paid even if spouses work. Here are the rules for spousal benefits. If the spouse applies for Social Security at full retirement age, the spouse's benefit equals 50% of the worker's PIA. The primary worker must have filed for benefits. For example, for Jill to claim a spousal benefit based on Jack's work record, Jack must have filed for his own Social Security benefits. This rule comes into play when we're talking about claiming strategies, and it can trip up a lot of people if they're not careful. A spouse must be at least 62 to file for a spousal benefit. If the spouse claims spousal benefits at 62, the benefit will be reduced, as we'll see here in just a moment. Spousal benefits do not earn delayed credits after 66. The most a spouse can ever get is 50% of the other spouse's PIA. And finally, you can only get a spousal benefit if it's more significant than the benefit available on your own record. That is, if 50% of your spouse's PIA is higher, that is, if 50% of your spouse's PIA is higher than your own PIA. And finally, you can only get a spousal benefit if it's more significant than the benefit available on your own record. That is, if 50% of your spouse's PIA is higher than your own PIA. Now, let's talk about how these benefits are calculated. The spousal benefit is 50% of the worker's PIA. The spousal benefit is 50% of the worker's PIA if they apply for Social Security at their full retirement age. So If Jack's PIA is 2,000 and Jill's PIA is 800, and if Jill applies for Social Security at her full retirement age, her benefit will equal 50% of Jack's PIA, $1,000. This is $200 more than her benefit would have been based on her own record. Now, what if the lower earning spouse's benefit is higher? That is, if their PIA is more than the spouse's PIA. In that case, they may not receive spousal benefit. They would only be paid their own benefit instead. The key to maximizing benefits for married couples is coordinating the benefits. When both spouses have relatively high PIAs, that is, the lower earning spouse's PIA is more than half of the higher earning spouse's PIA, it pays for both spouses to claim their respective benefits at age 70 to get the maximum delayed credits. Our calculators show that both spouses have an average or longer than average life expectancy. This will maximize the benefits over their lifetimes. Let's look at an example. John and Jane are married. They're both 62. John's PIA is $3,600 a month. Jane's PIA is $2,500 a month. Let's assume a life expectancy of 88 years for John and 96 for Jane. I'm going to show what our calculators say. The software identifies several claiming scenarios for John and Jane. In scenario 1, they both claim as soon as possible, at age 62. In scenario 2, they each claim at full retirement age, which is 67 for both of them. In scenario 3, John claims at 70, Jane at 62. In scenario 4, John claims at 70 and Jane claims at her full retirement age. In scenario 5, this is the maximum benefit based on life expectations of 88 for John and 96 for Jane. This scenario calls for each of them to claim at age 70. Here's a graph showing the lifetime benefits for each claiming scenario. Did you ever think a couple could receive $3 million in Social Security benefits over their lifetime? That can happen if you resist the urge to claim benefits at age 62. You can see here that they'll get the most lifetime benefits if they each claim their benefits at 70. Jane is not entitled to a spousal benefits because her benefit is higher than 50%. Jane will be entitled to a survivor benefit if John passes away. This chart shows the first-year survivor benefit for a longer living spouse. In this case, when John dies at 88, she'll step up into his benefit as her survivor benefit. Here are 3 scenarios that call for John to claim his benefit at 70. This will give Jane the highest survivor benefit. PIA is less than 50%. Mike and Mary are both 62. Mike's PIA is 3,600, Mary's is 800. Because her PIA is less than half of his, she should be entitled to a spousal benefit. But she can't take it until Mike claims his benefit. Does this mean he should claim early? Let's see what the software shows. Here we're looking at 3 possible claiming scenarios. There are many more, but let's focus on these 3. In scenario 1, they both claim now at 62. In scenario 2, Mary claims her benefit now and Mike delays till age 70. When Mike claims his benefit, Mary can add her spousal benefit. Her spousal add-on is the difference between her PIA and half of Mike's PIA. This amount will be added to her existing benefit. The maximum lifetime benefit shows Mary claiming at her full retirement age of 67, Mike claiming at 70. Mary adds on her spousal benefit when Mike starts to claim Social Security. As you can see at a glance, scenario 2 and 3 pay the most significant lifetime benefits. Mary's claiming at 62 versus 67 really doesn't make much of a difference in the long run. She might want to go ahead and get her benefits started at age 62. When Mike claims at 70, she can add on her spousal benefit. It doesn't make sense for Mike to claim his benefit early, even though it means that Mary must wait a few years to claim her spousal benefit. By maximizing his benefit, Mike is providing Mary with more survivor income in case he dies first. Here's another basic rule. A divorced spouse may be able to get spousal benefits based on an ex-spouse's work record. Divorce rules are similar to those for married couples with a few added restrictions. A person can receive Social Security based on an ex-spouse's work record, providing that the marriage lasted at least 10 years and the divorced person claiming the benefit is currently unmarried. It doesn't matter when the marriage and the divorce took place. If the marriage lasted 10 years, even if it occurred long ago, if the marriage lasted at least 10 years, even if it occurred long ago, A divorced person may be able to claim Social Security based on the ex-spouse's work record. The person claiming the benefit must currently be unmarried. You can claim a spousal benefit if you have more than one ex-spouse in your past. If the marriage has lasted at least 10 years, you can choose which spouse's record to claim benefit on. The order of the marriages and divorces does not matter. Other rules are that the ex-spouse must be at least 62 years old and that the divorce occurred more than 2 years ago. The ex-spouse doesn't need to have filed their benefit yet. There are a few more things to know about the benefits for divorced spouses. First, more than one ex-spouse can receive benefits on the same worker's record. So, if your ex-spouse has remarried a couple of times, all three exes can claim divorced spousal benefits as long as the marriage has lasted 10 years. Take, for example, Johnny Carson. He was married 4 times. His first marriage to Jody lasted 14 years. His second marriage to Joanne lasted 9 years. His third marriage to Joanna lasted 13 years. His fourth marriage to Alexis lasted 18. So, Jody and Joanna could have claimed divorced spouse benefits on his record because those marriages lasted at least 10 years. When he died in 2005, both Jody and Joanna could claim divorced spouse surviving benefits. Alexis could claim the regular surviving benefit because she was still married to him when he passed away. Joanne, she's out of luck because the marriage only lasted 9 years. The benefits paid to one ex-spouse do not affect those paid to the worker, the current spouse, or the other ex-spouses. You don't need to know the ex-spouse's whereabouts. Only enough identifying information is required so that the Social Security Administration can look up their record. You'll need to provide documentation showing the marriage and divorce dates. If you receive divorced spouse benefits and remarry, your benefits stop. However, based on your new spouse's work record, you may be eligible for spousal benefits, or you can switch to their benefits if you qualify for Social Security. Now let's move on to another critical issue. This is where things get to be a little less basic on survivor benefits. We'll try not to get too deep into the weeds in the details today, but survivor planning is essential and you should know a few things. Let's talk about those. For a surviving spouse to receive survivor benefits, the marriage must have lasted at least 9 months, except in the case of an accident. To start benefits, the survivor must be at least 60 years old or 50 if they are disabled. However, if the widow or widower applies before full retirement age, the benefit will be reduced. Some of the same principles that decide when to apply for regular retirement benefits also apply to survivor benefits. If you remarry before 60, you will be able to receive a survivor benefit based on your previous spouse's earning record unless your remarriage ends. We've seen cases where the survivor is contemplating remarriage in their late 50s. In those cases, we recommend a longer engagement to avoid losing out on your survivor benefits from the first spouse. If you remarry after 60, you can still receive those survivor benefits. Divorced spouse survivor benefits are available if the marriage lasted at least 10 years, as we saw with Johnny Carson. 2 of his ex-wives could claim divorced spouse survivor benefits after his death because those marriages lasted more than 10 years. Survivor benefits are worth twice as much as spousal benefits, 100% of the worker's PIA instead of 50%. If both spouses receive benefits and one spouse dies, the other may switch to the higher benefit. Here's a hypothetical example for you. Joe and Julie are married. They are both over full retirement age and receiving Social Security benefits. Joe's benefit is $2,000 and Julie's is $1,200 a month. If Joe dies, Julie's $1,200 a month will stop and she will start receiving $2,000 a month. It's critical to note about survivor planning is the loss of one benefit. Most widows and widowers need at least 2/3 of the income they were receiving as a married couple. So it's essential to plan for the loss of one spouse's Social Security benefits. Even though the higher benefit is often retained, the death of a spouse means the loss of a Social Security check. Please note that if Joe had maximized his benefit by filing at 70, say, his benefit of $2,600 with the additional delayed credits, Julie's survivor benefit would have been $2,600 instead of just $2,000. Julie's survivor benefit would have been $2,600 instead of just $2,000. Without going into too much detail, the main point I want to make here is that the amount of your survivor benefit will depend on two things: the age at which the deceased spouse initially claimed their Social Security benefits. This determines the original benefit, and the age at which the widow or widower claims the survivor benefit, which determines the actual benefit. The widow or widower will receive the highest income if the deceased spouse initially claimed their benefit at 70, and the survivor claims survivor benefit at full retirement age or later. Higher earning spouses who feel younger and healthy often don't consider the survivor benefits when claiming. However, as we saw in the examples of Bob and Betty and Mike and Mary, the survivor's income can be significantly lower if the higher earning spouse claims benefits early. Survivor planning is essential for married couples in shrewd Social Security planning. The decisions you make now can significantly influence your surviving spouse's standard of living later in life. It's a customized process. So please see me if you'd like help. What if you have already been widowed? Let's say your spouse died either before or after starting Social Security benefits. Or maybe you were married over 10 years, divorced, and your ex-spouse has died. Is there anything you can do to coordinate the survivor benefit with your retirement benefit to maximize income and lifetime benefits? The answer is yes. You can sequence your benefits to maximize their advantage. You can start with one benefit and switch to another. If the survivor benefit is higher, start your retirement benefit at 62 and switch to it at full retirement age. If your retirement benefit is higher, start your survivor benefit at age 60 and then switch to it at age 70. Let's take a look at an example of a widow, Wanda. She's 60 years old and has a PIA of 800. Her husband died before claiming Social Security. His PIA was 3,200. Now, Wanda has two options: 60 and hold out for the maximum benefit. She can also start her own reduced retirement benefit when she's 62 and then switch to the survivor benefit when she turns 66. Or she can start her survivor benefit now at age 60. This might be a natural choice since the benefit is higher. She wants to start earning some income immediately. However, she may not realize that claiming the benefit now permanently reduce her benefit for life to $2,288 versus $3,200 a month. Which scenario do you think would give her the most benefit over her lifetime? As you can see, Wanda receives more lifetime benefit if she just waits 2 years and then switches to her maximum survivor benefit at full retirement age. These claiming scenarios are not always intuitive. We've already discussed the disadvantages of early claiming regarding the actuarial reduction. But here's the other problem, one that might make early claiming moot. If you claim benefits before full retirement age and continue to work, your benefits will be withheld. This is called the earnings test. If you apply before full retirement age and earn more than $23,400 a year in 2025, $1 in benefits will be withheld for every $2 that you earn over $23,400. It's important to know that this money isn't indeed taken away. Instead, your benefit will be adjusted upward when you turn full retirement age to make it up as if you had applied later. If some of your benefits are withheld due to the earnings test, your new benefit will be higher as if you had started at 63, 64, 65 instead of at 62. This can be advantageous if you filed at 62 and then regretted it. Please don't let the annual earnings test discourage you from working. The more money you earn, the more money you'll have. Social Security does not penalize you for working. Once the adjustment is made, you will benefit more for the rest of your life. And of course, the earnings themselves will contribute to your financial well-being. The earnings test applies to every kind of benefit: retirement, spousal, survivor. It may even cause your spouse's benefits to be withheld. If John and Jane are 62 and Jane gets a spousal benefit off John's record and John goes back to work, then Jane's spousal benefit will be withheld. They are also targeting business owners who pay themselves a small salary to avoid the earnings test. You may be subject to extra scrutiny if you are one of those people. The earnings test, I know, it's a hassle. However, you can avoid it entirely by claiming Social Security after retirement. We're getting there, folks. Here's our last basic rule. Social Security benefits may be subject to income tax. The amount of tax you pay on your benefits depend on how much income you have. We won't spend too much time on this. Here's what you should know. This table shows taxation of benefits based on various income levels. Income means provisional income, which includes adjusted gross income plus one half of your Social Security benefits plus any tax exempt income. If a married couple's provisional income is under $32,000 a year, no benefits are taxed. If provisional income is between $32,000 and $44,000, up to 50% of the married couple's benefits is subject to tax. If provisional income is over $44,000, up to 85% of their benefits are subject to tax. Now, the thresholds for individual filers are $25,000 and $34,000 respectively. Regarding married couples filing separately and still living with their spouse, 85% of your Social Security is taxable regardless of your income level. The critical thing to remember here is that depending upon other income, up to 85% of your Social Security benefits is subject to tax. You can minimize taxes on Social Security by lowering your other income, especially investment income. But you should be aware that municipal bond interest, usually tax-free, counts as income and is calculated in the tax on Social Security benefits. Here are some things you can do. You can anticipate your required minimum distributions from your IRAs, which will cause you to be in a higher tax bracket and may cause some Social Security benefits to be taxed. Consider drawing down your IRAs early to reduce those RMDs. Consider converting a traditional IRA to a Roth IRA, which will generate tax-free income for you. Delay Social Security to reduce the year's benefits subject to tax. Reduce your expenses, pay down some debt, adopt a simpler lifestyle so you can live on less income. You should also continue to manage your taxes throughout retirement, not just the first couple years. As always, please consult your tax advisor about your own situation. If you have any questions, I'm here to help. Although we've covered a lot of ground today, you still may have some questions like, when should I apply for Social Security? What if I want to keep working? How much will my benefits be? How do I coordinate spousal benefits? What's the best long-term strategy for your situation? What should I do next? We'd gladly help you consider these questions individually and develop a plan for your specific situation. Social Security decisions can impact your financial future for decades, and a well-planned strategy can help you maximize your benefits and avoid costly mistakes. Let's make sure you get this right. Schedule a free consultation with me today for personalized guidance on when and how to claim your benefits. Click the link in the description to schedule an appointment. I look forward to helping you plan for a secure retirement. Thank you.